Big changes in the market, that's for sure. Holy moly, let's take a look at this chart right here. I've been showing this chart for the last several weeks because it is the one chart that rules them all. Look at on the far left-hand side. That's the yield curve as of Friday. You can see that it is really very, very flat from 3 months out to 5 years. And then it is slightly positive. And it's actually negative from 2 years to 5 years. So this is a very dire circumstance and tells us that we're going to have a major bear market a year from now. Hey everybody, Courtney Smith here with our weekly edition of Wall Street Wieners. Winners. That's right, winners. Sorry. Okay. But here, wieners. Okay, forget it. All right. Let's take a look. A lot of things changed this week. Let's take a look at some of these factors here. This chart, pretty much the same as last week, and it shows us that we're in a significant rally in a bear market. Now, you notice that lately, the last 4 days, we've really run out of gas. We moved higher, but just little teeny itsy bitsy creeps higher. Also, notice the purple predictor. Notice how the price, for example, was down ever so slightly, but the purple predictor was down more sharply. It seems to me that the smart money is starting to sell. In other words, it looks to me like the rally is just about over. Now, this was interesting. This is an unusual circumstance. Here's the Dow. We look in the upper right-hand corner, and the red line went down, showing that selling pressure went down, but buying pressure went down too. They both went down, but buying pressure went down more, and that's why the market has been struggling. We're running out of gas on the buying side. The NASDAQ, I've been talking about this. January is very bullish for small cap stocks. The NASDAQ has a lot more small cap stocks than the Dow or the S&P. Look at that purple predictor. That purple predictor is just skyrocketing up, suggesting, once again, not that the NASDAQ is going to go into a bull market tomorrow, but that the NASDAQ is going to gain on the S&P and the Dow. Seasonality, I'm still classing it as neutral. I put the green bar up there. It's up around 158. I think we have to go above 158 before I can get the seasonality to turn back to bullish. So at this point, seasonality is a non-player in this story. However, here we are. We can see that particularly the NASDAQ should be very bullish in pre-election years. This is really focused on the presidential election cycle, but it's basically saying for a very, very long time, pre-election years are very bullish. And we should see a rally not until the normal May, but all the way to July. But we're not seeing that. And that's bearish. When you should be seeing seasonal bullish price action, and instead we're seeing generally negative price action, that's actually ultra bearish. The yield curve got a little bit of a bounce, but you see, since we last spoke, it got actually down to 15. And I've said from the very beginning that when we get down to 25 or lower, this is really a bad situation, a bad situation. So we really need to be watching this, but this is telling us that we're going to have a significant bear market a year from now. Well, but Courtney, aren't we in a bear market now? Yeah, we are. But right now, all we've done is had a correction. It hasn't gone down 20, 30, 40, 50%. What this indicator, the yield curve indicator, is saying we're going to be down 40% next year. So let's keep going, though. There's a lot going on here. Asset allocation bounced up. We drew money out of the bond market and into the stock market. This was a big change as well. The stock market RISKDICATOR surmounted the previous highs, showing that we're moving out of the safe haven sectors, out of the defensive sectors, and money is moving into the riskier or sexier sectors, such as the NASDAQ. Is all this tying together? I hope so. Okay, global shares are bouncing, but they're still weaker than the U.S., so we want to ignore them at this point. Bonds sold off. I told you that the asset allocation, they moved money out of bonds, but nonetheless, this just looks like a retracement in a bull market. But clearly, the momentum is running out of gas. Look at the highs. The highs that we made a little over a week and a half ago were very strong. But this dip is pretty darn deep. We've almost gotten back to the lows that we had made in late December. So the momentum is running out of this bull market in the bonds. So I'm about to we'll stay one more week in the trade, but I'm going to probably get out of this a week from now. Bond key factors remain very suggestive of lower interest rates. So we got to stick with that. Gold is going up. Everything else is collapsing. So let's stick with the long side on bonds. The dollar under a lot of pressure. Well, why? Why is the dollar under a lot of pressure? A lot of it has to do with bond yields coming down. But the big thing is the Fed, when Jerome Powell came out and said, hey, we're going to be a little more flexible. The idea then came in that we're not going to be raising interest rates. We're going to be keeping them steady. So that was one of the big bullish features behind the dollar, and that feature is now gone. Gold, however, also stabilized. In other words, we might be in a little bit of a transition zone from where we were even a week ago. That's why I say lots of things are happening. So I'm long gold, but now I haven't made any money for a week. All right. So whenever I stop making money for a week, I'll stick with it for another week, but I have very little patience for having something turn around. So we may be in gold we may get out of it very quickly. Well, why? Well, let's look at this. So interesting, because the top panel, which is the euro, finally turned bullish. After really being neutral for several months, it actually turned a little bit bullish. The middle panel is the CRB index of commodity prices, all commodity prices. It was actually bearish for gold, but it turned somewhat bullish. The thing that really got me bullish was the bottom panel, the green line, which is the yen, the US yen, and it skyrocketed up. But now it's paused, and it is the factor that's affecting the price of gold more than anything, and that's why the price of gold has stabilized. So the key is to watch US yen. Okay, oil, we talked about this last week. We're starting to see the Saudis talk about cutting production by 1 million barrels a day. That's a big change. So look for oil to stabilize right in this low 50 area, but then I think it's going to start to break to the upside, and we're going to find a way to get long. Bitcoin actually came down. You can see purple predictor drifted lower. We recommended short positions up around 6,000. We're now currently trading down in the high 3,000 area. So that's a $1,200 gain. I'm sorry, $2,200 gain that you would have had on shorting Bitcoin. Right now, got to remain short. The trend is clearly lower. We really should be expecting a break of that 31.58 low that we made a couple of months ago. All right, that's what we got. Now, the new report coming out this week, I finished it. Now it's just a distribution issue. If you are a fully paid up member of Wall Street Winners, you should have received a copy of it on Friday. If you did not receive one, there's an email delivery problem, so contact support at Wealth Builder LLC. That's if you're a fully paid up member. You should have received it on Friday. Everybody else, we should be able to get it out here by Monday or Tuesday. Of course, if you're looking for great trade ideas, go to stockbutler.com. All right, that's it for me. Freebie. Really important that you keep coming back every week, because we're the only ones that called this bear move. And we're the only ones that are going to guide you through what's going to happen, the very turbulent times that are coming up over the next year. All right, that's it for me, freebies. Fully paid up members, hang on just 1 second.